Rob, can you share some perspective on what investors can do to help achieve the UN sustainability goals?
That's a big question, and there's probably a lot of answers to it, but I think one of the most common ways that people tend to think of private capital and investors being able to contribute to the UN SDGs is through the lens of impact investing. The idea that an investment shouldn't just have a financial return, but it should have a social and or environmental one as well. And that notion of impact investing really builds out across a spectrum, all the way from people who are doing what we call negative screening in terms of making sure that they're not just investing in tobacco companies or ammunition manufacturers, all the way through to people who are looking primarily for that social and environmental return and really kind of only secondarily for that financial return. And those might look more like philanthropic institutions or family offices. I think one of the challenges in the impact investing space, and I say this from the vantage point of an organization that's really been kind of one of the front runners in it for the past decade, is that there does tend to be a lot of fragmentation. That it's a small community, but there's a lot of siloing in terms of what we're focusing on and how we're focusing on it, and not really, up until recently, a lot of conversations around how can we better align what we're doing to have a bigger impact across the board to really help drive progress towards those SDGs. And I think one of the exciting things about being here in Concordia is the fact that you start to see those conversations happening. And it's happening with a small organization like ours who might make a $50,000 to $100,000 investment in a 2-year-old startup, all the way through to bigger funders and development agencies who are mobilizing billions of dollars of capital. And I think really the question isn't so much how can we achieve impact through investment, but how can we achieve it together? And really making sure that we identify those ways of collaborating and partnering with one another that add value to all of our respective portfolios.
When it comes to sustainability or impact investing, is our investment returns is it mutually exclusive that you have to think differently about investment returns when you're thinking about these big social types of investments?
That's a really good question and a very common one. And there are a lot of different answers on that. But I think my one answer to that is no. They are not mutually exclusive, and you can have them both at the same time. But it really sort of depends on really what you're looking for as an investor in terms of what is a good return. We operate as a venture capital firm, and in the venture capital space, you might have a traditional investor who has a portfolio of, let's say, 10 companies. They will invest equity into those companies, and because it's a high-risk sector, they'll be expecting an outsized return on those companies of 20x or 30x. Now, because it's a high-risk sector, that also means the vast majority of companies fail, and so your average venture capital portfolio might have 9 failed companies and one that actually provides an outsized return. Now, if you're an asset owner, or if you're a potential limited partner who's looking at putting money into one of these funds, one of the things to ask yourself is, what does a good return look like? Is one company returning the value of the portfolio and then some a good return for me? Or would I be happy with something that provides more of a steady income-producing dividend structure over the course of 5 to 7 years at a 3x return as opposed to a 20x return? And so it essentially kind of gets down to what the appetite for risk is and what the appetite for return is, much in the same way that you or I would take a look at our mutual fund portfolios and try and figure out, do we want dividends or do we want value? It's really kind of thinking through that intersection, which is the critical question to ask.
I know one of the topics you're interested in as an investor is solving global problems. Global problems, by definition, are big problems. Does the industry actually have to think about working in different ways to solve these types of problems? What's the solution from that standpoint?
I think for us, global problems really need to start with local solutions, largely because there's no global problem which people are grappling with in the same way. Climate change, for example. you'll have people in coastal cities who are worrying about flooding and rising sea levels. You'll have people in northern areas worrying about warming and the change to the ecosystems and agricultural practices. So everybody's might be grappling with the same problem, but they're doing so in a different way. And to address a lot of those challenges, we believe you need local solutions to that. And frankly, the best way that you're going to get solutions that solve those local problems that are a manifestation of that big global challenge is from people who have lived experience of that problem. So if you're talking about trying to help smallholder farmers take out crop insurance, for example, in West Africa, I'm headquartered in DC. I'm not the person to talk to about coming up with a solution that works for the pain points of the farmers, that integrates with the needs of the local insurance companies. The best ways of identifying those solutions are really talking with the people on the ground and having entrepreneurs who are in that space coming up with those ideas. So the approach that Village Capital takes is really making sure that we're getting out of the traditional blind spots of venture capital where you see half of all VC going to just 3 states in the US, but really making sure that we're going out to these countries where people are facing these big challenges and solving them in very innovative ways and very unique ways. And as a result, helping them to scale those solutions to then address those big problems. I'll give you one example going back to the crop insurance. We work with a company called Farm Drive. Farm Drive is based out of East Africa, and it's founded by 2 women entrepreneurs. They are both the first in their families to go to university, one for engineering, one for business. And they got to chatting while they were at university. They both came from agricultural families and realized that both of their families faced similar challenges in terms of accessing credit and covering the harvest. And if there was a problem with the harvest, their ability to access a loan to then pay for seeds or fertilizer for the next harvest cycle was really, really difficult. And so they started thinking through of ways to try and preempt that. And what they came up with was a solution that essentially allowed farmers to track the outputs of their harvest on their phones and use that to then create a credit score and work with other financial institutions, commercial financial institutions in East Africa to provide loans to those farmers. And ultimately, the reason why that solution was successful and the reason why it's continued to scale and grow is because it really addresses not only a pain point that the farmers have, but it also addresses a need from the commercial side to be able to tap into that space, but not necessarily knowing how, and not necessarily knowing and understanding the intricacies of the risk and the customer behavior to make that happen. And so Farm Drive really came up with this unique solution which bridged those 2 divides.
Last quick question would be, you mentioned mobile. As one of the themes of the conversations here is consistently in the developing world that you see mobile telephony as a key. When 5G comes along, is that a game changer from an investment standpoint, from the Farm Drive perspective? What was going to be the impact for these maybe smaller companies when the technology kind of undergoes this next iteration?
Well, I think in many ways you've seen, particularly in Africa, this leapfrogging in terms of technology, where access to mobile networks has allowed them to kind of skip the fixed line connectivity. And you're looking at, in many West African countries, for example, 2% fixed line penetration versus 120% mobile penetration. And I think you've already seen a lot of countries in West Africa, again in particular, be very aggressive about moving to 4G, 5G, LTE networks, and really trying to make use of the lessons that they're rapidly learning from economies like the US or markets in Europe, and being able to apply those to very specific perspectives. So you've seen the emergence, for example, in West Africa of these tower leasing companies which are helping make the infrastructure behind mobile a lot more affordable and easier to roll out in a way that wouldn't have been possible a few years ago. What does that in turn allow? Well, it in turn allows farmers to access things like gate prices for their harvest in a way that they wouldn't have been able to do before, and maybe would have left them vulnerable to underselling from middlemen or problems with figuring out which markets to supply to. So I think that there's a lot of studies out there that show the multiplier effect that mobile has on GDP and output. And I think one of the ways that you can see that most immediately is with entrepreneurs who are looking to leverage that new degree of connectivity for broader social and environmental good.
Rob, thanks very much indeed. Much appreciated.